Welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker, and Kerry Given, Dr. Duke is our guest today. Before we get started, I'm going to go over just a brief disclaimer that's at the bottom of all of our websites. The Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that out of the way, it's nice to talk to you again. I think it's been a long time. Weren't you, you were with Casey Platt back in the Sheridan days, weren't you?
Yes, that's correct. That's correct. Casey and I still talk occasionally.
Yeah, he was taking a Series 7 test the other day. I still talk to him too. So it's a small community, isn't it?
That's right.
I see Jim Riggio is joining us too, so he'll be calling in. But while Jim's calling in, Karen, maybe you want to, for the people who don't know you, maybe tell about who you are, what you do, that kind of stuff, and. You have the desktop, so you can share that whenever you're ready.
Oh, okay. Okay. Well, I'm clicking that and waiting for it to come up. Let's see here. Here we go. Let me tell you a little about me. I spent about 20 years in, well, actually a little more than that, in corporate America, and was trading stocks and then later options during that time, sort of part-time. And basically taught myself, together with a lot of courses and books and so forth, about how to trade options. But in the course of that, I became kind of annoyed with the amount of marketing hype and nonsense that's out there. And that really led to my first book, which was No Hype Options Trading. And it also has led to my talk that we're going to go through today on option trading myths. Now, on this slide, what I've done is I've simply taken a lot of different quotes from either marketing email pieces that I've received or off of websites, different trading conferences I've attended, a variety of places. But each one of these is actually a verbatim quote from some advertisement or speaker or whatever. And I'll just run down through these quickly. But we're going to basically debunk all of these. Now, a lot of these you might look at and say, well, common sense tells you that that isn't true, and that's certainly true. A lot of these are the classic too good to be true kind of statements. But I'm going to take you through some of the basic probabilities that are behind the pricing of options and show you why a lot of this just simply isn't true, just patently false. First one, you should only place low-risk reward trades, only risk $1 to make $3. Next one is, if I place a condor trade with an 84% probability of success, I will make a profit 10 months out of the year, only have 2 losing months, and therefore be profitable for the year. We will teach you how to find low-risk, high-probability trades, how to risk $156 to potentially make $1,000. We will teach you the secret strategies used by the market makers and floor traders. Sell credit spreads when IV rank is high, and buy debit spreads when IV rank is low. There's no need to adjust. Just let the probabilities work in your favor. So let's start at the basics and talk about what is known as the normal distribution or the Gaussian distribution. It's essentially the bell-shaped curve people often talk about. This particular slide, this particular graph, I actually took off of a website where a group of men were starting a weight loss program. And this was the distribution of their weights. And as you can see, it fell into the classic bell-shaped curve. So the height of the curve at any particular point gives you the probability of finding a man in that group at that weight. So for example, if you were to walk into that room blindfolded, you could get the probability of touching the first man that you touched being at, say, 250 pounds by just running up on this curve from 250 pounds on the x-axis. Now, if we apply that same probability distribution curve to stocks, then the current stock price is simply there at the top of the curve. And intuitively, we know what this is telling us. We know that if we have a stock that's trading at $150 today, that the probability is probably pretty high of it moving maybe 155, but a lot lower that it's going to go to 250 or something like that. But what this distribution does is allows us to put those intuitive, qualitative thoughts into quantitative measures that we can compare and actually look at different trades. Now, in this slide, what I've done is I've tried to show the difference with this curve in theory versus the reality of the stock price world. The curve that's kind of darker in the front is the real data. In other words, if you were to take one of these stocks and follow it for a year and just plot all of the up and down data, price data, you would get something like this. In other words, it would match the theoretical curve rather well, except on the extremes. And this is what they call the fat tails problem. In other words, those extreme tails, what you're seeing there is that the probability of a 3 or 4 standard deviation move is actually quite a bit higher than what you would expect from the probability distribution or the normal distribution. And so that's what we actually, again, we have seen that. Anybody that's traded very long has seen some large moves that just wouldn't be probable. If you looked at the statistics, they're just way out there. I mean, consider Netflix just a few weeks ago when they announced earnings, and I think they dropped over $100. I mean, it was a huge drop. And I didn't bother to figure out how many standard deviations that is, but it's certainly outside of what you might predict. Now here's the Black-Scholes equation, which is the equation that we can use to calculate the theoretical price of a call or a put at various conditions. Now notice the letters, the Greek letters that I've circled in red there. That's a phi, Greek letter phi. And in this case, phi is standing for that probability distribution function that we were just looking at a few minutes ago. And notice that the phi is in every term of the Black-Scholes equation. In other words, the probability of your particular option expiring with value or having value at some point in time is built into this equation. It's built into the pricing. In other words, the pricing is fundamentally built on the probabilities. Now, let's apply that to some of the trades that we often talk about. In this particular case, I just picked an example with SPX back in April and set up a classic iron condor, 1 standard deviation out of the money. And at the bottom, what I'm doing is calculating the expected return. In other words, the return that we would expect for this type of trade over many trades, kind of like sitting at the roulette table and calculating percentage of, or the probability of a black 8 coming up. Well, with one spin of the wheel, you might get anything. But if you did it 1,000 times, you're going to find that your percentages you predict for each of those numbers are going to turn out to be very, very close to reality. And so that's what this risk-adjusted or expected return is designed to do for us. Notice that we just simply multiply the probability of the success, or the winning trade, times the gain, and subtract the probability of the losing trade times the loss. And as you can see, what it tells us is that we're roughly going to break even or be a little bit in the hole at the end of several trades. So that's the classic high probability trade. But what about a low probability trade? Oftentimes, there's one firm out there that loves to promote the out-of-the-money bull call spread. And they call this a low-risk trade. And that's how they market it. But it's really a low probability trade. In this example, what we've done is just simply set up that call spread far out of the money. And so we have a 29% probability of the SPX closing above 1880. And so we multiply that probability times the gain and subtract the larger probability of a loss, even though it's a small loss. And in this case, it turns out to be dead even. So in other words, it's just going to break even over several trades of that type. So what you're seeing here is that this idea of placing a low risk reward trade or only risking $1 to make $3 is a perfectly reasonable thing to say, but one has to understand that he is playing a classic low probability trade. I'm not saying that that's a bad trade, but you need to understand that that's indeed what you're trying to do. The other statement here of how to risk $156 to make $1,000, well, I could also say that the classic lottery ticket where you only spend $1 and you can make $10 million, well, that's certainly the extreme of the low probability trade. And the middle statement there is one that I actually received a email advertising a guy's course. And some of the bullet points, he had several bullet points advertising what you're going to learn in his course. And one was, we will teach you how to find low risk, high probability trades. And as you can see, when you start looking at the probabilities that are behind the pricing of options, you realize that there's no such animal. If you have a high probability trade, by its very nature, it has a large potential loss, but it has a low probability of that loss occurring. And also by its very nature, it's going to have a relatively low return, even though it has a high probability of that return occurring. So really what we have in options trading are the two extremes, and of course everything in between. The classic high probability trade, where you have a high probability of a relatively small return and a low probability of a relatively large loss. And so the pattern that you'll see with this type of trade over time is that you'll have a lot of small gains, and every once in a while, it won't be very often, but every once in a while you'll have a large loss, and that'll wipe out many of those gains. The classic low probability curve, or trade rather, is just the opposite. There you have a lot of small losses. It's kind of like buying lottery tickets every week. You have many small losses. Probabilities are definitely not on your side. And what you're banking on is that someday it's going to hit, and I'm going to get that huge return. And I'm not trying to suggest that either one of these is the ideal, because a lot of this has to do with our own style of trading and our own risk tolerance and so forth. But let's look at some of the possibilities here if we were to engage. In this case, let's look at some high probability trades. Now on this slide, I have the results from 2013 for one of the services that I run, where we trade iron condors every month. And basically, on any given month, we start these at about 55 days to expiration. So on any given month, we have two trades going on, one for the current month and one for the next month out. But these are the actual results from 2013. And 2013 was a rough year for me. I ended up with about a $6,000 gain. That's on a position or an account that had about $50,000 in it. But notice what I did was I went back and said, okay, what if I put on each of those trades and just let them go to expiration with absolutely no management whatsoever? And you can see at the end of the year, I've been down by $23,000, lost about half my account. Now, when you think about it with the probabilities, this has to be one of those odd years. You would probably have other years. Just look at that stretch in between from April to October, where I had wins every month. Well, you might have a year that would go like that, where you'd be $20-some thousand up. But the point of the probabilities is that over the long term, you're going to be basically running towards zero. And so that's what gets us to this statement that I have in red here in the middle of this slide. The risk-adjusted returns of all option strategies will tend towards zero over the long term. Now, technically that should state, and in my book you'll find that I actually state it as will tend toward the cost of capital over the long term. And of course, after you subtract out, especially when the cost of capital is as low as it is today, after you subtract out bid-ask slippage and your costs of trading and so forth, then you're going to be easily at zero or negative. Now let me tell you one little story that's interesting about that book and the point that I made in the book about this. I was at one trading conference, I guess 2 or 3 years ago, right after that book came out. And a guy came up to me after my talk and explained that he was a pension fund manager and had something like $60 billion under management. And he was starting to look into using options to protect his fund a bit and also add some income. And he said he picked up my book and he was shocked when he found this statement. And he just thought, well, that can't be true, especially given everything he'd heard about options trading. And so he came to that conference and went through the exhibit hall, and at every booth whether it be the Chicago Board Options Exchange or Fidelity or Schwab or whatever. At every booth, he asked him, he pointed out this statement in the book and said, is this true? And what he found is that everybody told him, yeah, it is. Now, he also told me, he said some of them seemed kind of embarrassed by it and almost begrudgingly said, well, technically it's true, but, and so forth. But this is what's happened. It's basically been covered up by the marketing in this business, unfortunately. So what does this tell us? How are we going to beat the odds? How are we going to make any money in this business? You make it only by managing the risk. That's the bottom line. So this basically tells you that second statement that we had, advertising that I could trade condors, and since it's a high probability trade, I don't have to worry about those losses. Well, what we realize now is that over time, all those losses are going to wipe out all my gains, so it really doesn't do anything for me. The last statement there was actually taken from a webinar from a rather famous guy in the business, and he was talking about iron condor trades, and he actually made the statement, there's no need to really adjust these things. You just let the probabilities work in your favor. And it just kind of amazes me that people make these kind of statements because they simply are not true. Now, another area that people get confused about are the effects of implied volatility. So let's think about two extreme examples. One I took from just this recent correction, looking at SPX as its volatility peaked at about 31%, and we're going to compare some debit and credit spreads at that point in time. Because you've probably heard people tell you that you really ought to trade your iron condors when volatility is high, or they'll tell you that you ought to sell credit spreads when volatility is high, or something like that. So we'll look at that and see how that works out. The other example I'm going to look through is and share with you is Netflix on its earnings announcement back in April. On the day of the announcement, when they were going to announce after the close, at-the-money implied volatility was up at about 63%. By the next day after the announcement, it had dropped down to 39%. So what we're going to do is we're going to look at debit and credit spreads at the money before the announcement and after the announcement. And if some of the myths that we've seen are true, then we should see the credit spreads really trade much better before the announcement when volatility was so high. So let's look at SPX first. On the 15th, that's when we basically hit the low intraday and then it bounced. SPX closed at 1862. The VIX was at 31%, or peaked at 31%, I should say. It actually dropped off a bit from that by the end of the day. And we had 36 days in the November options. And so what I did is I looked at 3 different call spreads. We're going to buy each of these call spreads. So these are 3 debit spreads. One is in the money at 1800, 1810. We're going to buy that for 725. We have probability that's relatively high at 61%. And our maximum profit would be 38% as long as SPX closes over 1810 at November expiration. Then we have the at-the-money spread that we can buy for $600, 50-50 probability, and still reasonable gain around 65%. And then we can move out of the money. Remember, this is the one that everybody says, or at least some people are selling as the magic trade. We can buy that one for $350, hence they say it's a low-risk trade because you have less invested. But look at the probability, 38%. It's the lowest probability trade here, but it also promises the largest gain. If it hits, it's going to make a lot of money. So let's compare that with the credit spreads at the same strike prices. Notice, without going through them each, notice that they're all almost identical. Now, one caveat here. I went back and back tested this and used the closing prices to develop these, and I used the midpoint of the spreads. Now, if you did this during the middle of the day, when the market's open, what you're going to find is that these things match up exactly the same because they have to. Put-call parity mandates that. There's no question about it. Otherwise, you could set up a trade, a box spread, or something like that, and lock in a risk-free profit. So the bottom line here is that no matter if you sell a credit spread or buy a debit spread, it doesn't matter where volatility is. you're still going to have the same risk-reward profile. Now let's look at the Netflix example. Back in April, closed on 21st at $348. IV was pretty high at 63%. So if the myth about selling credit spreads is right, then selling this 340, 350 put spread should be the maximum trade, should be ideal. And that looks like a 92% return. But what about if we buy the debit spread at the same prices, or same strike prices, I should say? There we've got an 88% return. In other words, they're almost the same, very close. Let's look at the next day. Netflix is now trading at 373, but IV has dropped to 39%. Now, if we buy the at-the-money call spread, 360 to 370, that's an 81% potential profit. On the other hand, if we sell the put spread at the same strikes, we have exactly the same potential profit at 81%. So in other words, it doesn't make any difference whether we're selling a credit spread at high volatility or buying a debit spread when volatility is low. It's the same trade. So this idea of selling credit spreads when IV rank is high and buying debit spreads when IV rank is low is just simply based on a misunderstanding of the effects of volatility. Now let me point out one thing. If somebody's telling you that they always like to sell strangles or sell straddles or something like that, well, obviously they're looking for high volatility because those options that they're selling are going to be very expensive at that time. But when you start talking about spreads, that's a whole different ballgame because now I'm selling a high volatility option, an expensive option, but I'm also having to buy an expensive option. So my volatility effects basically cancel themselves out. And that's why we don't see any advantage to this credit spreads. Now the other thing, I like to trade iron condors, and I've often heard people make the comment that you want to trade your iron condors when volatility is high. Well, think about that for a minute. If you're positioning your iron condor on an index and you're doing it based on being $100 out of the money every time, that's how you set it up. If SPX is at 1900, you go up $100 and sell that credit spread, and then go down $100 and sell that credit spread. Well, if you're doing that, if you're setting a set amount of money out of the money each time, well, then when volatility goes up, you're going to see magically that you're getting a higher credit for those spreads. But that isn't an advantage to you because you're getting a higher credit because you're actually at a lower probability now of success. If you position your spreads based on the probability, based on a standard deviation, in other words, then the implied volatility level is built into that calculation. So in effect, your risk then from month to month as you put on these condors is consistent. And so that again is part of why people get confused by that, I think. Okay, one last one. We will teach you the secret strategies used by the market makers and floor traders. This is one of my favorites. You see this all the time. If you go to a money show or a Traders Expo or anything like that, I guarantee you can go to a conference talks all day long, and you will hear several people that will give you this pitch in one form or another. Sometimes it comes as a kind of a subtle, I was on the floor for several years and I know more than you do. I even know one guy that seems to think that he's going to sell a lot of his services simply by being obnoxious and arrogant. But bottom line is that there really is no secret or best strategy. Now, to try and debunk this, just think for a minute about how a market maker actually makes his living. First of all, he's making his living based on the spread. I mean, it's kind of like the used car salesman. If I'm selling cars, I go down to the auction and I buy a car at wholesale, bring it back to my lot, and sell it as close as I can to a retail price. I mean, I sell it for as high a price as I can. Well, the market maker is doing exactly the same thing. He's trying to get as close to the bid or ask price, whether he's buying or selling. And he has to make as many of those trades as he can because he's only making a few cents each time. because that bid-ask spread has gotten more and more narrow. In fact, that's why you don't see many people doing that anymore. It's only large firms that can do the volume. That's who's making the markets these days. So the volume is critical. So he basically, how he succeeds is by volume and by controlling his risk. He's always monitoring the delta of his collection of options and keeping that within some reasonable bound. And so he's either going long stock or shorting stock in order to keep that balanced. So if we're going to learn anything with a market maker, it's just simply that we have to control our risk. It's nothing else. And when one of these guys tells you that he always had butterflies in his collection when he was making markets, or he had condors or whatever, well, yeah, sure. I mean, you could take that huge collection of options and build anything you want out of it. But he's not trading butterflies. That's silly. He's simply taking every trade he can and monitoring it to make sure he stays as close to delta neutral as he can. He's not trading butterflies. He's not trading condors, and that's just silly. So this idea, I often call it the holy grail fallacy. In other words, we're wandering around sometimes, and I think we subtly, sometimes we don't even realize we're doing it, that we're seeking the secret. We're seeking the advantage. We're convinced that somebody out there is making a fortune based on some secret that they have that I need to find out. And it just simply isn't true. Now, that's not to say that you can't learn how to trade and do better. I'm not suggesting that. But just don't get caught up in the idea that somebody out there has the Holy Grail and knows the secret. So those are what I find are the most common risk, reward, and other types of option trading myths. And when we understand how the probabilities control the pricing, I mean, another way to look at this is think about right now, if you were to, with the SPX getting up close to 2,000, I would guess if you went down to, say, 1,500, 1,600, you could probably sell a put for a nickel or something like that. And you can imagine one person might look at that trade and say, wow, I'm going to sell this put, and I'm going to sell 500 of them, bring in a lot of cash, and I'm going to make a fortune because the probabilities are on my side. It's definitely going to expire worthless. You could have somebody on the other side of that trade thinking just the opposite, thinking I'm going to buy that put, and I know it'll expire worthless most of the time, but one of these days we're going to have the big crash, and I'm going to make millions. Well, the probabilities are built into those prices. Neither one has an advantage, and that's what we have to keep in mind. So our advantage comes from managing the risk for our trades. That's how we get an edge. So I'll put in my brief advertisement here, and then we can take questions if we have any. I have several services on my website. That's the address down there, parkwoodcapitalllc.com. And there's my email address if you'd like to send me any questions about this or whatever. I'd be glad to answer them. And I will point out that I just sent my second book to the publisher, I guess it was last week. So I think we'll have that out by the end of the year. And that one is dedicated to non-directional trading. In other words, delta neutral trading, basically. You have any questions out there, Tom?
Well, Jim Riggio, he had a funny one. He said, Kerry, if I sign up within the next hour, would any of these companies also throw in a set of Ginsu knives?
Well, that's not too far-fetched, really. You see that kind of stuff all the time.
So I know you said you like iron condors. Is that primarily what you trade?
Yeah, well, the bulk of my trading is really in what I would call conservative trading. I mean, for example, I trade a lot of just plain old dividend-playing stocks, and I'll sell calls against them occasionally when they're wandering sideways, and I use puts to protect those positions. I do some collars in that account. I also buy a lot of spiders and Qs and do the same thing there. I'll sell calls occasionally, but mostly for that account, I'm just holding spiders and Qs, and there I'll simply buy and sell based on just overall market. In fact, one of the measures that I use for those accounts is the IBD big picture assessment. They have a technical indicator that they put out. And if they go from anywhere from marketing correction to market and confirmed uptrend, once they come off of that uptrend, then I'll sell those positions and hold them in cash. And then I have another section of money, but it's smaller, that I'll trade actual spread trading directionally on stocks. In other words, I'm just trading the bounce on Apple or whatever it might be. And then I've got probably 20% of my net worth that I trade in condors and similar trades, delta neutral trading.
Kerry, this is Jim. Thank you so much for coming on and speaking to our community. When you talk about trading spread trades, one of the things that we end up doing in my company is that we take a look at what percentile the option skew is trading at, because as you talked about, when you do a spread, right, I'm buying one option and I'm selling another. So if the difference between their implied volatilities is statistically higher or lower than its norm, we like to try to end up taking advantage of buying lower than norm or lower IVs and selling higher IVs, because it is a zero-sum game, right? Some people make money, some people lose money. We think that if we're consistently buying lower IVs and selling higher IVs, especially compared to their norms, that would make sense within reason. And within reason, I mean like this. A lot of times, many people in our community love these butterflies below the money. Okay, a lot of people I know are big John Locke fans. He ends up having a specific trade where he's buying a put, let's say, a little bit above the money on the SPY or the S&P 500 or the Russell. He's then selling and a put below the money, okay, where the IVs are significantly higher. He's rounding out his butterfly where he's buying a very high V below the money, but that IV is so far below the money that he's not paying a lot for it. So do I really care if the IV, okay, below the money is twice as much if I'm only paying, a dime or 20 cents for that put, but I'm receiving, $3 for the other one? So statistically, the way I take a look at it is that there's a statistical advantage because he is buying lower IVs, selling higher IVs in a market-neutral type of trade. Can you comment on that? Because I know a lot of people, this is one of their favorite trades.
Yeah, I think fundamentally what you're talking about is absolutely valid, and fundamentally what it's based on is what I'll call just the reversion to the mean. If you look at implied volatility, that's what you're banking on. And when I'm trading calendar spreads, I'm always looking very closely at where we are with the volatility, because they're just, that's a classic trade that you don't want to get into a calendar spread when volatility is too high, because it's more likely to drop on you than to rise. So I think that's what you're basically doing with those spreads.
Yeah, because when it comes to volatility, one of the things that I take a look at, if you take a look at the VIX, right, and I know that there are a lot of ETFs, and they all that try to replicate the VIX, and they all have their issues because of contango and backwardation and other issues. But when I take a look at any type of security or any type of indice, I know of no other security or index that has a greater daily volatility as compared to its longer-term volatility. If you take a look at what the one-day average is, in terms of like a one-day average true range, versus how much does it move on average, let's say, over 90 days. The VIX has a lot of movement on a daily basis, but it kind of spins its wheels. It tends to end up staying within ranges. Yes, you have the breakouts and everything, but there's not an indicator that I know has a greater reversion to the mean characteristics than volatility itself.
That's right. That's exactly right. No, I think what you're going through is very powerful. There's no question about that. And that's another way that you can build an edge for yourself.
So, yeah, and that's why it's funny. It's I don't know. Have you ever met John Locke?
No, I haven't.
Okay, just one of our fellow traders. I've worked with him on a couple of different projects, and I love it because John is He's a great trader, and as I go through the theoreticals of why his trades work, he's like, I don't know, I just know it works. I've been doing it so long that I know it works.
Yeah. Well, in a sense, I've often wondered if the fact that people will tell you that you ought to sell credit spreads when volatility is high, maybe that just came out of the really valid point of some people saying, well, I'm going to buy options when volatility is low, and I'm going to sell them when it's high. Well, that's certainly true, but that's not true of the spreads.
Yeah, you know, I have found the same thing. The reason why volatility is the highest, there's a reason.
Yeah, that's right.
There was an old options trader, floor trader, saying of buy low vols, sell high vols, buy extremely high vols. If you take a look at 2008, I know a lot of options firms, professional, managers that just ended up making a killing because they were selling vols at they were buying vols when they were at, say, 15 in the beginning. They were selling the 20s, the 25s. When they got up to 30, 35, they were buying the vols in 2008. And as we know, they ended up exploding, and at that point, they ended up making a lot of money. So I think that there is a trader aspect to this that
Sure.
you end up having a feel for it. So, one of the things whenever I have to end up reviewing anybody's trading strategy, I ask them, where do you think your edge is?
That's right. That's exactly right.
Right, because it's almost like the old joke about when you sit at the poker table. If you look around and see who the sucker is, and if you can't find him, guess what?
Yeah, that's one of the things. Oftentimes when I sit down with somebody, they've inquired about taking some kind of coaching from me or something, and we'll go through what they've done before and what they've been trained on and so forth. And it's fascinated me and kind of disappointed me as well. How many people tell me I've taken this course or that course, and I'll ask them, well, did you study probabilities? Do you understand that? And no, they don't. And what about volatility? Do you understand implied volatility and how that works and how that plays a role here? And half the time they tell me no on that as well. And it just kind of blows my mind that anybody's trading options and doesn't understand those two concepts.
I had a lunch 2 days ago with the CEO of the Berlin Stock Exchange and a PhD quant who used to end up managing 100 of them at J.P. Morgan. And they asked me, when we talked about things, everything got to, and they used the mathematical term expected return, right? That's exactly the math that you were taking everybody through.
Right.
They ended up asking me, okay, what's your expected return, and define to us how you're calculating it and why you believe you have a positive expected return. I mean, in a nutshell, that's the question.
Right, exactly. I should have pointed it out to everybody that's on the line is, if you're not familiar with expected returns, one of the things I should have pointed out there when I went through that section, if you have the percentage of probability of gain times your maximum gain, and you subtract the probability of loss times the maximum loss, it should come out, if options are priced correctly, it should come out roughly at zero. And how you manage that is if you have a risk management system so that you cut that loss down. If you cut that term down, then you can have a positive expectation.
The single biggest thing that I end up seeing with professional traders, a few weeks ago we had a former Goldman Sachs trader on. His name was Ian Scott, and the single biggest thing that I see different about people like that is their ability to control risk. I've known this guy now, and I've been working with him for about a half a year. And as I turn to him on things and saying, uh-oh, this one's getting in trouble, or, are you going to do anything? He's like, I sold it $3 ago. Okay. Like, oh, that was good. Okay.
And that was the secret if you talk to any of these guys that used to make markets on the seaboard or wherever. I mean, they didn't take big risks. I mean, that's the illusion. I think a lot of us ordinary retail folk out here have this illusion of market makers and people in the exchanges as being these risk-taking cowboys, and that just simply isn't true.
It's interesting, I don't know if you're familiar with the company Livol and Livol Securities. They have their LVX system, but a lot of people are disappointed in their risk graphs because they won't show specifically the expiration graph. Because some people love to see the expiration graph on a butterfly. And their CEO one time used the expression to me. He says, you got a better chance of getting hit by lightning than landing on the point of that butterfly. Why should I show it to you? It's only an illusion.
That's right. That's right.
And she was right.
And of course, the other similar, and almost everybody that trades or trains people about trading options will always say, close your positions before that last week of expiration. And they'll just say, they'll state that as kind of a general rule, but then if you actually look into it and you look at how gamma is accelerating in that last week, you start to appreciate why. I mean, risk is getting out of sight.
It's unbelievable. The thing is that there have been several studies. We ran a study. Our results were very, very similar to, I know some people were familiar with Tom Sosnoff and Tasty Trade and Tom Preston, and they had run a study showing selling straddles at the money on a whole bunch of different underlyings. Okay, and they were basically selling straddles instead of putting on butterflies because they just wanted to end up making the point on the trade. And what they ended up doing is that they ended up closing their trades at 25% of their potential profit, and they just had a limit order. And if it came in at 25%, they took it off. If it didn't make it, they'd let it run to expiration.
Right.
Taking it off at 25%, 50%, 75%, and leaving it on to the end. Almost every underlying, and they chose, whatever it was, the 20, highest volume, trading stocks. Almost every one of them came in at it was more profitable to take it off once you hit 25% or 50% of your profitable gains than if you let things run and take that huge gamma risk in the last week.
Exactly.
Hey, we did have a question from Ray. It says, does your presentation today infer we do no adjustments and no self-imposed max loss exit?
Oh, no, not at all. In fact, it's just the opposite.
Yeah, I was going to say, I got the opposite also out of your talk.
Yeah,
I did too.
Yeah, I was trying to make the point that if you just let these things run, you're not going to make any money. In fact, in theory, if you put on these trades and just let them run year after year, you shouldn't have a huge loss. It should all even out pretty close, but probably in the hole because of slippage and so forth. But you have to manage the trade. I don't care what kind of options trade you're talking about. You have to manage it. That's the bottom line here.
One of the other trades that I know some people were familiar with, and I know it has a statistical advantage, it's to sell naked puts on the indexes far below the money. And as I said, when you take a look at that, when the average implied volatility is, let's say, 15 for the VIX, if we're going to use the SPX for an example, and if I'm selling a put so far below the money that I'm getting 35 implied volatility for it, I have a large statistical advantage. And if I could guarantee that I could play 1 million rolls at this game, 1 million months at this game, I'm going to win. I'm a guaranteed winner, okay, if I could end up playing 1 million wins. Now, some of those losses are going to be pretty dramatic. Now, if that loss happens, let's say, on roll 12 of my million, month 12, I'm going to have a life-altering experience, okay? I'm going to lose so much money. Now, here's the problem. The one other guarantee I can give you is that none of us are going to live 1 million months or 1 million expirations. Yeah. So what do you do? What do you do? How do you end up playing it so that you take controlled risk? Because everybody, and you hear stories about traders who've made just incredible amounts of money, usually end up, okay, in incredible flame outs and crash and burn because of they didn't manage their risk appropriately.
I mean, one of my favorite trades that I used in one of my retirement accounts, I mean, it's one of my kind of conservative accounts, if you will, is I just alternate between selling puts and selling calls. But the secret of that success, in my opinion, is number one, you use the stock that you have a lot of faith in. You think it's a good, solid stock. It's not going to disappear tomorrow. And number two, you always have the cash necessary to take the exercise. And so if you're selling puts on IBM, yeah, it may drop sometimes, so you have a stop loss that kicks you out of those trades. But generally speaking, it drops a little bit, you have the stock put to you, sell calls the next month, and you just keep alternating. And it's a very powerful trade. But people get out there on the edge and start selling 100 puts on Google when they don't have near the cash they'd have to have if it pulls back a little bit.
I love that trade. A matter of fact, I love it on both sides at the same time. I love to say, right? I love to say, my target is 200 shares. I love to own 100 shares, sell the covered call above the money, sell the put below the money. If we go down and I get assigned and now I have 200 shares, I like to sell one call above the money, one call below the money, collect the money again. Just keep doing this over and over and over again.
That's a very good idea. I hadn't thought about that alteration on it. Yeah.
The problem is that it's boring, it takes discipline, and people end up saying, you know, show me the magic sauce. How do I become a gazillionaire, okay, in the next 12 months?
Exactly. Exactly. That's the problem. I mentioned before that I often talk to people before they sign up for a course or whatever, and I turn away a lot of people because a lot of people come to me with this idea, this conviction that they're sure that in option trading they can turn their $5,000 account into $1 million. And I just say, you know, you're not going to be happy with me. It'd be better if we just part ways here.
Mm-hmm. I think having misaligned expectations sometimes is the single biggest problem in our industry.
It definitely is. The other factor that I think is an issue is the people that have capital to trade, they built that capital by being very good at something. I mean, you know, it might be a doctor, engineer, whatever, scientist, it could be a lot of things. But I guarantee you that whatever their profession was, they didn't succeed by being good at it 60% of the time. And so they'll get into trading and they'll think, well, I lost this trade. I might have stopped it out and taken a reasonable loss, but they feel like they've got to be able to be as successful as they were as an engineer or whatever it is. And so the perfectionist drives them crazy because they can't, intuitively, they can't believe that they could actually make money in a business and lose 20 or 30% of the time.
As you ended up going through your expected return, I mean, I've seen systems. I don't know if you know Dennis Gartman. Do you know the name?
I know the name, yeah.
Right, big commodities trader. I saw him speak at a conference once, and I loved his speech because as a great risk manager, when he became a trader, his wife was his accountant. And after he, you know, left and he went out on his own, at the end of the first year, his wife said, you know, she did the books and says, you know, I have good news and I have bad news. The good news is that you made a little bit of money in your first year, but you lost 53% of your trades. Okay, so the next year, the same thing ends up happening. Well, you know, there's better news and there's worse news. Okay, you made more money, but the problem was you lost 60% of your trades. As he tells the story, he goes, the third year, he goes, wife goes, you know, I'm not sure if I get this or not, but I think I have it. He says, you had a record year. You had your best year ever. You made X number of dollars, but you lost 64% of your trades. I think I have this thing figured out. If you could just lose 80% of your trades, you're going to be a freaking millionaire. You know, and he says it, okay, in a lighthearted way to get people to end up understanding expected returns. If and some people saying, I want to end up winning 90% of the time. You know, if you win 90% of the time, and when you win, okay, you're winning 10. I mean, yeah, and 10% of the time you're losing 100. You're just at a break even when you go through your expected return. So I want, if I'm going to end, I don't mind winning 10% of the time. If I lose 10 when I lose, but I make 200 and I only win 10% of the time, I got a great trading system.
Right. Right.
Okay. I just have to end up having enough iterations, enough bets to be able to put on so that the law of large numbers can catch up to my probabilities.
Right. Exactly.
Another I was going to say, we had one more question. Do you guard your condors with unit puts to guard against catastrophic loss, like a flash crash or gaps?
No, I usually, what I'm doing is let's take this recent correction as an example. I got kind of jerked in and out of that one in that I forget the exact timing, but I was buying puts to protect my condor as the delta of my short puts was getting larger. And the market would kind of jerk around there, and I had bought my full put position, and then it went back up a little bit, and I took off some of my puts, and then it came back down, and I put all the puts back on again. And then at the bottom, at the intraday bottom at, what was that, the 15th of the month, I think, at that bottom, it was interesting. The SPX had come down so that it was almost exactly at my short put of my condor spreads. But my entire position was actually at break even because the volatility had spiked so high that my put hedges, of course, were just making a fortune. And then, of course, when it bounced up the next day, I started peeling my puts off. And in fact, it looks like we're going to close that month's position for about a 13% gain. But that's how I protect it.
So you protect it as it goes.
Right, right. I've known some people.
Right? The key that I've always seen, if you end up doing that, is you can't be afraid to take your profits on the put once its market starts to find its bottom. Sometimes I got to tell you, it's really, really hard selling those puts after you've made money on them. It's like, but I don't want to sell them. I need them. And you're trying to hold on to them for dear life. And that's the time that they're most dear. That's the time you're going to make the most money on them.
Right. And that's why typically I'm kind of phasing in and out, because like that very next day, the 16th, I believe it was, that it started to look like it maybe is coming back up. I sold about half of my puts, but kept about half of them. So I was kind of putting a foot in both camps.
Okay. By the way, everybody, I want you to end up listening to that. Every great trader, every professional trader I know ends up doing that. They don't end up ever saying, I'm so smart, I'm declaring the bottom of the market here, so therefore I'm selling all of my puts. They scale in and they scale out, okay, when it comes to things. They never end up, okay, thinking that they know better than the market and this is the spot that I have to do everything at.
Yep, you're exactly right. That's why I like non-directional trading a lot, because, this idea of predicting the future is pretty tough. I don't know too many people who do it.
Well, it looks like we've, I guess Adrian had one question. It says, sell naked calls in an IRA, is that allowed? I think at some brokers it is.
Not that I know of. It's unlimited risk to the upside, so therefore they can't end up determining what your margin should end up being. If you sell naked puts, okay, your margin in IRA will end up being the amount to end up buying the stock if you get assigned.
Right, the so-called fully cash secured put.
Mm-hmm.
Right. Okay, I think that's it for the questions. So, Kerry, thank you very much for joining us. It's been a pleasure.
It was my pleasure. Thank you very much. I enjoyed the discussion.
On behalf of the whole community, Kerry, we really appreciate you coming on and sharing, okay, a very, very insightful presentation. Thank you.
Great. Thank you.
All right. Well, thanks, everybody, for coming, and we'll see you next week.